Thank you very much indeed, Shan. Yeah, so you'll have heard already this morning some great presentations which have given you some really insightful details on trade finance, the problem that it's trying to address from an investor standpoint, and the opportunity with the trade finance gap. First slide. At TradeFlow Capital, we started our journey back in 2016, looking very much at the trade gap, the trade finance gap, which you will have seen and heard about this morning. Within that, though, we noticed that there was a very specific underbanked and underserved sector that was the SME, the small, medium-sized enterprises, which have unfortunately still even increased their suffering post the COVID situation. John Denton here, the ICC, International Chamber of Commerce Secretary General, noting that just earlier this year. When our team looked at the problem that SMEs were facing and why banks in particular, where there was a lot of data, could not serve and support them with traditional lending. So we started to see some key issues here around the ability to lend to, particularly to SMEs, smaller firms. And in the commodity sector, we're talking about firms with less than $500 million turnover. And if you were a manufacturer, of course, with $500 million turnover, you'd be pretty big. But as a bulk commodity trader moving soybeans, grains, diesel, etc., all over the world, you're often considered too small to be profitable to a bank for traditional lending. Next slide, please. So this is quite a useful slide. There's a lot of stuff going on here. You should be able to take a further detailed look after the conference today. But on the left-hand side, we can see that there's at the top left, fully constrained. We're seeing a lot of Eastern Pacific, Asia, South Asia, also Sub-Saharan Africa. Almost a third of companies saying, SMEs saying they were financially constrained in terms of their borrowing capability. And it's not that banks or other lenders don't want to lend, but often there's a lack of data on those entities. Either they have less than 3 years track record, or there's just not enough information about, what they have been doing in terms of the actual business track record. Some of you may have heard about Basel III. Now we have Basel IV. These are banking regulations. On the bottom left here, the bank regulations tightening has just meant that there's less and less credit risk mitigation benefits in terms of banks owning assets. Now, obviously, we have trade finance funds. We've heard about invoice receivable opportunities, even direct lending funds stepping in to fill some of that gap where banks can no longer profitably do the lending. And so if we look at the top right here on this slide, when we looked at the reasons why banks, in particular, where there's a lot of data, rejected trades, a lot of the time it was because they didn't have enough data, whether it was KYC information, there wasn't enough track record, or the bank couldn't make enough money on it because of changes in the way that they actually put capital requirements on their balance sheet, etc. And so we asked the question, what do SMEs need to do? So we are at the very early stage of the supply chain. So TradeFlow Capital, we built a solution as well as an investment opportunity for investors in trade finance, which is at the beginning where the trades actually start. So we're at the very sort of the front of the supply chain where we enable the trade to happen in the first place. We focus on SMEs and we help bulk commodity trades, import exports happen, which in turn generate invoices and which then flow down to other trade finance solutions that we've heard about earlier today. Because of as a fund manager, we had to look at digitization because some of the problems here that banks could not lend is because of the cost of customer acquisition, the cost of KYC and constant AML monitoring. So we are a weird hybrid of fintech and fund management, where we had to buy in and build digital solutions to actually digitize the handling of things, because the the opportunity as well as the headache was to get around a lot of the risks, which Simon covered very well in his presentation. The easy solution was to buy the commodity and own it. So as a neutral principle, we actually buy it. The commodity. We even charter ships if necessary as the charter party, renting the vessels that the cargoes are on. So we have real control and oversight over who inspects cargoes, and we can phone the captain and say turn left instead of turn right if there was ever a default. Although, as we've heard already this morning, default rates are minuscule, very, very low risk in this type of asset class. So to handle all the documentation around standing in the middle between a supplier and a buyer, as a non-lender, as a neutral principle, we had to digitize. So that's what we've done to try to create that solution. Next slide, please. So because 74% of applications for SMEs for traditional lending with the banks, that is, are rejected, we focused in on that we believe that out of $1.6 trillion trade finance gap, almost half of that is these SMEs moving bulk commodities around, agris, metals, energy, the real lifeblood of economies. As a result, the ICC has partnered with us to try to promote this solution further, because we don't compete with banks. We work and collaborate with traditional lenders. And if we go on to the next slide, I'll try to explain what we're trying to achieve here. So we have basically, offers further diversification. So trade finance asset class, whether you're investing in invoice receivables or lending into the sector, offers a great opportunity for diversification. That is clear, and we saw some great statistics there in terms of the lack of correlation with other asset classes there in the presentations this morning. But we took another further diversification level. So within trade finance asset class, you can even diversify further. We have swapped credit risk because we don't lend. We don't need credit insurance because we don't lend money to anybody. What we've done is swap that for physical real world risks, which can be insured or managed. The goods can be insured against damage or loss. If the ship disappears, that's insured, etc., etc. So fully asset backed. And so last year during COVID, it did become tricky to try to price credit on its own. But we knew always, because we don't price credit, we could always scorecard a transaction. We always knew what the price of cocoa was, what the price of coffee was, what the price of grains was. It does mean that we are focused on bulk commodities. We don't do fashion. We don't do Ferraris, unfortunately. But it still means we're able to address a very big issue and offer a very safe haven and a kind of fixed income style return with very low standard deviation of returns, less than 0.7% on an annualized basis to investors. So nice yield and fixed income alternative, we believe. And on that point, if on the bottom right of this slide here, BBB+. So we're now in the process of having buying and owning the asset to help the SME company do the trade, and then generate the invoice, and then they can refinance stuff through other trade finance financing opportunities and strategies, like Velo Trade, and like Simon and others are operating. But what we're able to do is help unlock some of the liquidity from the banks. So we now have banks giving their SME customers to us. We get the trade done using our funds, because we operate funds with investors in it, the TradeFlow funds, and we buy the asset, we control it. So it's like a collateral manager, but skin in the game. We have that asset always at a discount, and that discount is arranged by and calculated by our scorecard system, which we developed. That's the proprietary sort of secret sauce, as it were. And then the banks can even lend to our funds at a senior level in terms of the debt structure. So we hopefully facilitate liquidity from traditional lenders. Next slide, please. So I talk about swapping credit risk for physical risks, and most of those physical risks are actually covered by what are called marine cargo all risk insurance. And the credit risk insurance market is one of its own, and we saw some credit risk insurers pulling away from the market during COVID, and they came back sort of around October, November last year. But that was a bit of an issue for some of the lending strategies. What we have done is, relying upon the all risk insurance of marine, which covers also warehouse storage, we're able to swap that for real world stuff. What happens if the cargo gets damaged or lost or other things happen? And we're able to mitigate that. And the marine cargo insurance market is much, much bigger and has a larger capacity, we feel, than the credit risk on its own. And so we feel, we can manage those risks much better than the pure credit risk, particularly in emerging markets. We are going in to address a problem and also open up an investment opportunity in emerging markets. We're talking about Asia Pacific, South Asia, Africa, parts of the Middle East, etc., where it is often difficult just to get up-to-date financial data on the SMEs. But we can see what they've been doing. They're much easier to track their trading record and business record, which involves external parties. And so this is, we believe, a very interesting opportunity. We've been running for 3 years now, the fund, which we launched, the US dollar TradeFlow fund, and averaging around 6% net without any leverage whatsoever, because we also have been encountering the same issue our SME counterparties encountered, was that for a very long time we were too small to be big enough to get traditional lending from the banks. But now that has been happily changing as the market and our business has developed. Next slide, please. So this is just a quick slide just on digitization. I think Simon made a very good point early in terms of promoting best practice. And so we are standardizing the infrastructure, standardizing the legal documentation, introducing best practice to emerging market SMEs in order to actually push things going, to push and promote best practice, and also introducing digitization to emerging markets as well, helping them get rid of the paperwork and actually increase transparency and security around all transactions. And that's again where we work with the ICC in order to actually look at digital standardization as well. Next slide, please. Just very quickly, I'll just finish off here. This slide here is just to illustrate, nothing too fancy here. It's, it's financial engineering where, we have the end buyers, the SMEs. They often have some capital, often their own business capital, but no leverage. And so they invest a little bit of money into each trade by paying us a support fee. That's our sort of market price risk hedge in case the very rare event we have to sell the cargo to somebody else. If not, it may not be a credit risk event, it could be an operational event, port shut, etc., that they just cannot take delivery. Our fund then, investors are sort of second tier risk capital, and now we have the opportunity to try to help banks lend even directly or indirectly into their own SME customer pool at a senior debt level, sort of BBB plus or better, through our sort of solution. So hopefully a solution where we're collaborative with traditional lenders, with trade finance funds and banks, and also giving investors a very interesting diversification opportunity. So as you can see, there's a lot of different flavors. There's a lot of different types of ways you can invest in trade finance asset class. And then within trade finance asset class, you can further diversify within trade finance assets across the beginning of the supply chain where we're at, all the way down to the sort of invoice receivables after the deal has been done. Thank you very much indeed.